Hi everyone, welcome to today's Wyoming Small Business Development Center Network webinar, Funding Your Small Business Startup or Expansion. I'm Tyler and I'll be helping to facilitate this session. Feel free to ask questions throughout the webinar using the chat feature. The Wyoming Small Business Development Center Network is a statewide resource funded by the Wyoming Business Council and the U.S. Small Business Administration. We offer free, confidential advice to all Wyoming entrepreneurs and small business owners. Our advisors are located across the state and they can help you start a business, grow your existing one, or recover from challenges. Now I'd like to introduce PJ Burns, a member of the Wyoming SBDC Network and Regional Director for Northeast Wyoming.
Thanks, Tyler. Welcome everybody to the webinar. I'm really excited to have you all online today. So joining me also on the presentation is Tammi Hanshaw, Lender Relations Specialist with the U.S. Small Business Administration. Tammi, will you take a few seconds to introduce yourself?
Sure. Hi, thanks, PJ, and thank you everybody for being here. My name is Tammi Hanshaw, and as PJ mentioned, I'm the Lender Relations Specialist for the Wyoming District Office of the Small Business Administration. So we have a 4-person office that covers the entire state. So we are small but mighty, and we do love to come out and help you wherever you are. So
perfect. Thanks, Tammi, for joining us on this presentation. And Tammi and I will be kind of switching back and forth between some of the slides and some of the sections to bring both of our expertise into this presentation. So again, thanks for joining us. So today we're going to go through a few different topics. So first we're going to compare some different funding sources and kind of think about and talk about how to match those sources to what your business needs are. We're going to identify some steps to take before you seek funding. You know what, and we're going to really talk a lot more about debt financing, but a lot of these really apply no matter what type of funding that you're trying to get. So we'll talk about a little bit on and the differences between startup and expansion. We're going to evaluate some financial forecasts. We do have a tool in the handout section of a cash flow projection that we're going to share later on in the presentation. So I encourage you to download that. But our goal today is to teach you about business funding to help you be more successful in either your launch or the expansion of your business. So again, we're going to start out with the different types of funding sources that you might already know about, or maybe some you hadn't thought of before. Again, our goal is, or your goal is, to match the funding source to what you're going to use that funding for. Besides the debt funding, like I said, that we're going to go into detail with, there are some different types of sources. You may have heard about some startup challenges that happen around the state of Wyoming. Those were started by Impact 307, and they're still going on. So what a startup challenge is, it's basically grant type funding, and it's mostly for startups. It's a competition. It depends on what region that you live in, whether they're even having a startup challenge. It does require those competitors in the startup challenge to go in depth in preparation. It's usually a pitch type of competition where you get up in front of some judges, and then maybe a final competition where you get up and you provide a pitch to the audience, and then they decide who is going to win this funding that's in that startup challenge. So again, it is a competition, so if you do apply to a startup challenge, it's not guaranteed that you're going to get that funding. It might be helpful in order to narrow down what your pitch is going to be or write a business plan, but it does depend on if that type of challenge is available in your area. Another type of funding that maybe some of you have heard about through some Googling for business funding is the SBIR STTR grants. It's really a contract or a grant to fund research and development, solving a problem. So this is really an extremely niche type of funding that some very high-tech businesses could get. It's quite complicated. and it does require a great deal of reporting. So if the SBIR, STTR is something that you're interested in exploring or understanding more about it, you can contact either your local regional director or myself, and we can go through what that is specifically. But again, it's for research and development for solving complex problems. A lot of people come to Small Business Development Center to talk about grants. Everybody's telling me there's startup grants out there. Well, that's just not necessarily true. It's especially for government grants. Any government grants that you might find out, they are really for specific uses. It's rare or basically non-existent for a startup grant or expansion needs grant is available because they don't cover just overhead type of expenses. Some examples of some grants that are out there, again, for specific uses, is our workforce training grant through the Wyoming Department of Workforce Services. That is a reimbursement grant. So if you want to get some training for your staff and it's going to benefit your business and benefit your staff, you can put in for a grant prior to going to the training and then submit for reimbursement afterwards if you were accepted. Wyoming Business Council has a market expansion grant. So if you're looking to do some marketing, going to an outside trade show, bringing in some possible buyers into your business, that market expansion grant, again, may be an avenue to get some reimbursement for expanding outside of the state and possibly outside of the country. There's also some grants out there to help your business be more energy efficient, where the state would pay for somebody to come in and evaluate how you can be more energy efficient, or replacing fixtures and light bulbs in order for your business to be more efficient. Again, very specific purposes for these grants that do require you to provide back proof that you have done the things or already paid for the things that you're asking to be reimbursed for. Another alternative, which is really your first step, I believe, is bootstrapping. And what bootstrapping means is that you are funding your own business. And in one way or another, every entrepreneur has to do this definitely at the beginning. Before you get your business set up. You may be able to bootstrap your own expansion by planning for that expansion and starting to save for that equipment that you need to purchase, or budgeting for a new employee, or budgeting and getting yourself set up to be more able to purchase that larger business space or add on to your business. So one thing is the planning that I just talked about. Will the amount that you have available to invest in your own business, is it sufficient for what your needs are? That planning side of it is so important. And like Tyler said, we've got regional directors all across the state to help you with that, to make sure that you will have enough through bootstrapping. Now, some service-based businesses, that might be all that they need, is to save up and invest in their own business. Other businesses that require a lot more investment, or having to purchase a building, that's really hard to do by yourself with bootstrapping, but hopefully this presentation will help you be prepared. Another thing we get asked about a lot are investors, or what's called equity financing. Investors not only bring some funding into your business, but they also should bring some experience to your management team. Maybe you getting some investors that have done this before, or they are great at managing people, or they're great at operations. So those investors should be more than just a funding dump into your business. You should find folks that will really help you to manage and your business grow even more. So some considerations whenever you're thinking about investors, they're difficult to find. Right? It's kind of a complex process of trying to find investors or venture capital funds. Another thing is when you find investors, they're wanting something back for their investment. And so you might have to provide them some equity in your business in order to do that. That's a percentage of ownership in your business. So you'll lose some control of your business because you won't own 100% of it. Also, it's complex in figuring out what those investors want in return for their investment. What percentage are they going to own? What are they going to get back either every quarter or at the end of the year? How are you going to compensate those investors? And so that complexity also goes into working out what that deal is between your business and the investors. And it's definitely more likely to get an investors with a high growth companies that they can start reaping those benefits of that partial ownership or that equity in your business more quickly. Lastly, I'd like to talk a little bit here about the different types of debt financing. And then we're going to really focus on debt financing and how to be best prepared for that before you go to that lender. One source there are online lenders, and lots of them these days, or utilizing a personal credit card, some kind of online credit. So this is sometimes one of the easiest ways to find debt financing. And sometimes it can be very, you apply online to this online lender, and within a few days, you do get that funding for your business. Now, some considerations for this kind of funding is that the interest rates are going to be much higher. It can be a little bit risky because some of those online lenders are really predatory lenders that they may have a huge interest rate. They may have an extra fee for paying it off early. Or maybe you'll get on a website that's going to steal all your information. And so be very, very careful if you're looking at online lenders and making sure that it is a legit company that's offering that. Another consideration with online lenders is that you really don't get to talk to a person. A banker can, like an investor, be a sounding board. They can be an experienced partner in your partner. I use that word loosely, an experienced advisor in your business. So you don't get that if you use an online lender. We're going to really focus on commercial loans. And so some things that they bring to the table is underwriting. They're going to really get into the nitty-gritty of your business and your experience and all the things we're going to talk about here next in the next section in underwriting this loan and making sure that it is a sound investment for that bank. They're going to do their due diligence. They're going to look into your credit history, and we're going to talk more about why that is. They might provide a little bit of a reality check, right? Hey, you need to think about these different threats to your business. Is the background of this particular industry that you're in variable and reliant on other things that you don't have control over, and how are you going to vet that out? And again, it provides you a point of contact. So that's a pro with going with a commercial lender that has experience in the industry that you're in. Some consideration is the varying interest rates. Make sure that you really understand the loan product that you're getting into. It's going to be really dependent upon your credit. Again, we're going to go more in depth with that in our next section. And they're going to ask you to do some really in-depth preparation before you go and see them, a business plan, a cash flow projection, those types of things. But requiring that of you to bring to the table whenever you look to that kind of financing is only going to benefit you and your business because you've done your homework per se. And even if it's primarily for the reason to try to get financing to get started or expand, it's absolutely going to benefit you in the long run and have an impact on your success. Another type of financing that you might get or look into are loans from family and friends. This can certainly be possibly easier than a commercial loan, but it may have some additional considerations. If you get a loan from a family member, Thanksgiving's coming up this week, and how is it going to affect your relationship? Is it going to be tough a year from now at Thanksgiving to sit across from mom and dad that invested in your business if your business is struggling and they haven't gotten the return on their investment that you had promised. Again, how are you going to pay them back? Will it be with interest? Just like good fences make good neighbors, good agreements make, good close investors. So make sure you get something in writing of what they are investing in your business for what purpose and how they're going to get paid back, and then make sure you comply with what that agreement has. I put due diligence on here. What that really means is, mom and dad might decide to invest in your business because they love you and they're your mom and dad, right? They may not look into and ask you to write out that business plan and have a financial plan like a cash flow projection. And by not requiring you to do all those things or talking those out with you, may decrease the amount of success that your business or expansion might have. So make sure to do that in any scenario that you may be looking into. So those are some different types of financing for your business that you might look into, consider, that are out there. So
PJ, I might add that a lot of times you won't just use one of those sources for your project. You might look into 2 or 3 of them. So that's something to consider as well.
Thanks, Tammi. Absolutely right. It's not an all or nothing type of scenario. So something that commercial lenders really look for is, we can put it in a nutshell with 5 areas, with those 5 C's of credit, understanding that criteria that lenders use when they're evaluating your loan application. So Tammi and I are going to go through together these 5 C's of credit. Those include your character, capacity, capital, collateral you're bringing to the table, and then conditions. We're going to look at each one of these in a lot more detail. And the goal of this section is for you to understand these factors that your lender will consider in reviewing that loan application, which documents, which items that you need to bring to the table with your lender, as well as some things that you need to look at internally before going to sit down and maybe fixing or shoring up. First, we're going to start with character. So what are we talking about whenever we look at character? So it's really your personal credit worthiness. So they're looking at who you are as a person, really your personal credit report. Your credit history has a very significant impact on your ability to get credit for your business, and in terms of what lenders will be able to offer you. If you're a sole proprietor versus an LLC, they're really looking at you as the individual. As a sole proprietor, there's no legal difference between you and your business. If you are a startup business that doesn't have any financial history or any business collateral, you're more than likely be required to offer a personal guarantee for the loan. They're really going to look at you. How much is your personal debt to income ratio? How much credit are you using? In the past, have you personally made on time or late payments? Are you in arrears with anyone at this time? So this is an opportunity for you to really look at your credit report. And on the screen right now is a website that you can download your personal credit report for free through the Fair Credit Reporting Act. And so take a look at what you've got on your credit report. Fix anything that you need to fix, and then it'll take at least 30 days for that to come off of your credit report. Is there anything on there that's fraudulent? This is a good idea just to look at this once a year anyway, to make sure that there's nothing fraudulent on there. Are there any mistakes? You have the right to dispute information on your personal credit report. Again, you'll definitely want to clean up anything that needs to be cleaned up before you go and talk to the banker and have them pull your credit report. The impact of your credit score on your ability to is really great and cannot really be underestimated. If you are a high risk borrower and you're more likely to be denied credit, the lower your credit score is really pertains to the higher your interest rate will be. And so these numbers on the bottom kind of, when you pull your credit report, you'll get a number back somewhere between 300 or lower and 850. 850 is the excellent credit. So somewhere on this upper echelon, 700 or higher is considered good credit. The banker will consider you lower risk as a borrower and eligible for better credit terms. But what about my business credit? People ask. So you're an expanding business. You've been in business for a while. You've got that bank account. You've got that relationship with your lender. They will probably still look at your personal credit, especially if you're a sole proprietor or an LLC. The age of your business will matter because then you'll have a lot more history of your business with the banker. But really, only large and sophisticated businesses probably don't need to rely on the business owner's personal credit history. As small businesses grow, of course, you're going to build credit with your vendors. You're going to have that credit history with the bank, but they will look at your personal credit history, probably pretty much regardless. So this is why it's so important to have that relationship with your banker as you grow your business, and especially if you plan on expanding in the future. Tammi, you're up to talk about capacity.
So capacity is probably the most, arguably the most important of the 5 C's. So it's essentially the financial strength of your business. So is there going to be adequate cash flow to cover expenses on time? Are you making your payments in full, including that new loan payment? So for existing businesses, capacity is usually measured by how you've done in the past. And lenders will look at your historical performance through your business financial statements and your tax returns. So you can expect to present at least 2 years of tax returns and financial statements. If you go through an SBA loan, they're going to ask for 3. If you're a business startup with no financial history, maybe even expanding a current business, or you're making major changes to your current business operations, a lender will want to see your projections through a pro forma financial statement. It's a projected income statement. It's also called a projected profit and loss statement. What it does is it estimates how much money you'll make, so your revenues, how much money you'll need to spend, so your expenses, and what you estimate your profit to be. That's your revenue minus your expenses. Your projected balance sheet estimates what assets your business will have, what liabilities it has, and what the owner's equity is projected to be. We'll talk about that in a little more detail a little bit later on in the presentation. Your lender will look at your character and capacity. One of the ways that they could do this is with your resume. And also any resumes of your key personnel. So they'll be looking for any business management experience you may have, or any industry experience for the types of businesses that you're starting. Now, a resume isn't always a required document, but if you're new to the bank, if you're a new client, it could be useful in letting the lenders get to know you. So you want to open a restaurant, but you've never owned a restaurant. But you have 15 years of experience managing an upscale hotel dining room in Denver. A resume could introduce you and your experience to a lender really quickly and clearly. You might also consider updating your LinkedIn profile or any social media accounts, really, especially if there isn't much information about you or your business online. Current profile will show that you have connections in your industry and the experience that you have to offer that industry. Also, if you have any key personnel with great experience that will add strength to your business, include their resumes as well. Anything you have that shows how your business can be successful. So an example is if you own a dental clinic, but you aren't a dentist, you'll still need a dentist to be successful. Or for your restaurant, maybe you aren't a Michelin 5-star chef, but you know one and they'll be working for you. Those are things that a resume could quickly and easily show a lender. Okay. A key element of capacity is your cash flow, and that's shown in a cash conversion cycle. like the chart that you see on your screen. So to improve the cash flow of your business, you'll need to keep more cash in your business for longer whenever you can. And this cycle shows how you can use cash to buy the materials, to make your product, provide your service, then you make the sale, and then you receive cash from your customers. Now, if you don't immediately receive cash when you sell a product or do a service, say you set a 30-day net payment, then you might see an extra step in this cycle, sending an invoice and then collecting on that invoice before you get cash back into your business. So these are some of the things that you can do if you're struggling with cash flow. You might ask your suppliers for 30-day terms instead of paying cash for raw materials. Or maybe you invoice your customers immediately when you provide your product or service. Maybe you can give a discount to customers who pay on their invoices quickly, like a 10-day net discount of 1%. If you're struggling with cash flow, some of the things that you should not do is postpone paying estimated taxes. If you're not able to pay your taxes, that's a huge red flag and a warning sign that your business may no longer be viable. You don't want to pay your vendors late. They could cut off your supply, and then where would you be? You definitely don't want to hide it from your lender. You know, being in that business, they've likely seen this situation before, and they might be able to give you some advice on how to help resolve the issues before they get worse. Remember, your lender is part of your team, like PJ mentioned earlier. They could be like your accountant or your lawyer. They might be able to help you. And turning it back to you, PJ.
So our next session is capital, and capital is the money used to build, run, or grow a business. Equity is the resources that the owners invest in the business. So capital includes funds the owner has invested in the business. For an existing business, it's shown in the balance sheet as owner's equity. So a lender expects you to contribute to the product by making a down payment or what's called equity injection. Sometimes people come to me and they're in that startup phase and they're like, yeah, we just need a bank loan to get started, and I really don't want to put my own money into it. That's not something that you would want to adhere to if you're sitting in front of a lender, because if a bank is going to make an investment in your business, they also expect you as that business owner to make an investment into the business, bringing something to the table. Whenever you're looking at a financing source, you should be prepared to provide a down payment of 20 to 30% on that total loan. The percentage down, as well as the interest rate, really depends on what the lender believes the risk of your business is. Occasionally, you might find a lender willing to take 15 to 10% down. That's very rare for a startup business or for specialized equipment. But if you're expanding, again, you've been a good customer of this bank, they may request less down on a loan for expansion. The documentation for an equity injection can include, like Tammy said, bank statements, your equipment purchase receipts. Keeping adequate records are essential when applying for a loan. And especially with traditional lenders, your lack of equity or money that you're willing to invest in your own business may mean that the loan request will be turned down. Non-traditional lenders, online lenders, micro lenders that Tammy will go over may not have this same requirement. But again, understand what products that you're looking into are going to best suit the type of loan that you want to get. So Tammy, would you talk about collateral?
Yeah, absolutely. Thanks. So collateral, these are the resources, assets, anything of value that can be pledged to secure the loan. And collateral serves as a secondary source of payment if you default on your loan. And you might need to pledge personal assets if your business assets aren't enough to fully secure the loan amount that you're requesting. Now, collateral shouldn't be confused with a guarantee. A guarantee is a personal commitment to repay the loan, whether or not there's enough collateral to secure it. Lenders will usually take a lien on collateral so that if you default on the loan, they'll take possession of that asset and they'll sell it to apply the proceeds towards the outstanding balance of the loan. And they'll usually require a first lien position on any assets that are purchased with a loan proceed. So if you go and you buy an oven with your loan proceeds, the lender would be the first in line to collect any funds from the sale of that oven should you default on that loan. Lenders take collateral to reduce their risk, and that will look at the balance sheet and personal financial statements to see what might be available and what is pledged as collateral. Individual lenders' policies will determine if they'll also require a loan on the business's home if you own one. Just a couple things to keep in mind. Strong collateral will not make up for a weak business plan or idea. You still need to have that strong business plan. And a personal guarantee is a business owner's legally binding agreement to promise to repay the loan in full, even if your business fails. What you're doing is you're demonstrating your commitment to the success of the business. It's usually required by all lenders, maybe even micro lenders. So just as an example, SBA requires an absolute and unconditional guarantee from all individuals who own 20% or more of the business.
Thanks for going over that. So another thing with collateral I wanted to just kind of interject on is that if you're expanding or purchasing equipment, sometimes that collateral falls on that equipment that you're purchasing or equipment that the business already owns or possibly property that the business already owns. For startup businesses, some people do utilize what they personally own, like a home, that they utilize that as collateral against a startup business loan.
Thanks, PJ.
The last C in the 5C is conditions. So conditions include loan conditions such as the interest rate, the repayment term, the amount of principal. Conditions also include what you will use the loan for. For example, if you're buying a fixed asset like real estate or equipment, or if you're using it for inventory or using it for working capitals. Lenders will also consider conditions outside of the borrower's control that I kind of talked about earlier, such as industry trends. Is that industry growing? Is it falling? What's going on in the local economy right now, or the economy of where your customers are? Are there any pending legislative or regulatory changes? These are things that you should know as a business owner just starting out, and definitely something that you'll get to know if you are already in business and ready to expand. Lenders will expect you to address these factors in your business plan. These types of factors are some data or information that Wyoming Small Business Development Center can help you gather. We've got a center under our umbrella called the Market Research Center. And so what they can do is they can look at who are your competitors. Let's do a competitor analysis. What's going on in this industry nationwide? How about regionally? Is it growing? Is it falling? So including that type of information in your business plan is crucial. And that's something that your Wyoming SBDC can help you with. Business plan or pitch deck. If you're going for a loan, you're definitely going to want to have a business plan that outlines what your plans are for expansion, how you are going to market. Do you already have some existing customers asking you for more of what you're providing, and that's why you need to expand? Or are you looking into just buying that extra piece of equipment that will help you get a new customer sector, right? All of that should be explained in that business plan. If you are thinking about starting, you'll want to have some knowledge in that industry, like Tammi outlined before. You might want to find a lender that has experience in your industry or has loaned to this type of business before. If you are serving the mineral industry, you're definitely going to want to find a lender who's been helping those businesses that serve the mineral industry because of the volatile nature of that industry. If your application is denied, or that lender is really looking at that business plan and asking a lot of questions, ask for their feedback. What are they thinking that you haven't thought of that you need to address? Work with your SBDC advisor A lot of times I will review business plans and I'll put my what if I was the banker hat on, and I'd start asking questions and helping the business owner or the entrepreneur that's just starting out understand, okay, think about what if this happened in the economy, how would you address it? It's also important to know that financial institutions have different priorities and risk tolerance. That very same proposal or business plan that you put in front of XYZ banker just might not fit into their portfolio. So you might go to a different lender if you've gone back to your SBDC advisor, come through that business plan, that financial cash flow projection, and see if a different lender will be able to work with you on what you're trying to do. On those conditions, some conditions you can control and some of them you can't. Anticipate some risks that might face your business in the near future and in the extended future, and put in your business plan how you will address those challenges. So there are a couple of different types of commercial loan products that are out there. A term loan, that's something that your bank will talk about. Those are loans that are a fixed amount that you pay back monthly for a specific period of time. Typically, it would be a fixed interest rate. It might be more appropriate if those funds will be used for a one-time purchase, and that would be for buying a fixed asset like equipment, building, and land. Again, could be for that startup or that expansion. The loan may also include a little bit of additional if you're in startup to deal with those working capital type of expenditures like payroll, but really expanding by purchasing a building or additional equipment is really probably most appropriate and easier to get approval for a term loan. Your bank may have a product that is more like a revolving line of credit. And that is really more appropriate if the loan will be used to fund some ongoing needs that you'll be able to pay back with income coming into the business. Lines of credit are generally drawn down, repaid, then possibly drawn down again, usually multiple times during the life of a loan. A revolving line of credit might be what a startup service business would need, as most of the costs will be overhead and it might be invoicing out and have a longer term before that customer of yours pays that invoice. An expansion where a business adds additional staff. Again, this is overhead. A revolving line of credit may be more appropriate than a term loan. So Tammi, will you talk about SBA loans and what those are and how those can be used?
Absolutely. Thank you so much. Talking about how SBA can help small businesses is one of my favorite pastimes. So, just to be clear, I wanted to make sure, SBA is not a direct lender. So we work with our partner lenders to deliver our loan programs. They need to show that a borrower has no credit available elsewhere. And so they'll typically look at a conventional loan first. They'll look at all of your documentation. They'll determine your needs. They'll decide if an SBA product might be best for your business. If you are familiar with SBA loans, you might be able to approach them and say, hey, would this work for me? And they'll look at that. But our lenders do maintain the autonomy to make decisions. So if they'd agree that SBA might be a good fit, then they can work within our program guidelines to ensure that you have reasonable terms set for your loan. So an SBA, a lender will usually use SBA to reduce their risk that's associated. Maybe you're a startup business. Maybe you have a collateral shortfall and can't secure a loan entirely. Their risk is lessened by using our government guarantee. So if you default on the loan, then the government will cover a certain percentage of that loan amount so that the lender has less risk. And we aren't the only guaranteed loans in town. USDA also offers them. And I want to be clear, this doesn't mean that you no longer owe the money if you default. If you have an SBA loan, then SBA purchases that loan from the lender, then we're going to work directly with you or through Treasury garnishments to recover the funds. It still could have a negative impact on your future credit needs. So you'll want to be sure to make sure that you're paying those government loans. So you might be wondering why you would want to use an SBA loan. And there's a lot of uses for our loans, okay? I mean, you can purchase or renovate real estate. You can buy machinery and equipment, furniture and fixtures. You can even export with the assistance. You know, if you're a startup business, maybe you need that longer maturity. A conventional loan life of equipment is usually set to about 5 to 6 years. So a conventional loan would only give you a 5 to 6 year maturity on a loan. SBA can expand that maturity up to 10 years. That can help you reduce your monthly payments so that it might be a little bit easier for you as a small business to manage. Maybe a startup, you don't have any history of revenues, but you have a good business sense, you have the experience in the industry, and the lender thinks it's a really cool idea. They might be able to front the money with the SBA guarantee. If you are in a business that's looking to expand, maybe you need a line of credit to help with working capital while you purchase more materials, or maybe you need to hire employees for growth. These are all things that SBA can help you with. There are multiple different loan options with our 7A program. It is our largest loan program because of all of these different options. You might look at, if you need a loan under $500,000, you could maybe do a small loan. We do have standard loans that go up to $5 million. We have cap lines that are our lines of credit up to $5 million. They can help you with, say you have a contract with the government, and the contract isn't expected to pay you until 6 months out, but you need that line of credit to be able to buy the materials in order to produce the equipment that's made for that contract. That is a great use of cap lines. We have our community advantage, which it's based to help serve those underserved markets. So a woman-owned business, a veteran-owned business, a minority-owned business might be eligible for a community advantage loan. We have export programs that if you are looking to export, we have a grant that you can use if you're dipping your toe in export and you want to maybe attend a trade show to see how you might fit into that industry. That's something that we can help you with. We also offer microloans. I saved that to last because we do this microloan goes from $500 to $50,000. We do have one intermediary in Wyoming that can deliver that loan program to you, and that's the Wyoming Women's Business Center. Not only do they offer the loan, but they can also offer technical assistance. So a lot of the same things that SBDC and PJ can do for you. You can do that along with your micro loan. We do have a new 7A loan program called the Working Capital Pilot Program. It's basically up to $5 million, and you can do a term loan or a line of credit. It's based on our export working capital program, but it's also used for domestic purposes. And so one of the things that you can look at is it can help you to borrow against your inventory up to 60% or up to 85% of your accounts receivables. So it's just a different structure of a loan that you can use to help you, much the same way that an exporting loan could help you, but you're able to use it for domestic purposes as well. And then you also have our 504 loan program. The 504 loan program, it's great for real estate. You would essentially go to a primary lender that would do 50% of your project, and then a community development company comes in and does 40% of the project. and you're left with a 10% equity injection. Could be a little bit more if you're a startup, but if you're expanding, you're looking at a 10% equity injection. So the benefit to you is that it's a smaller down payment, and it's a fixed mortgage. The downside is that you would be writing 2 checks. It's almost like you have a second mortgage. You pay your primary lender and you pay the community development company for your SBA loan. And the other thing that we do is we work with disasters. Some of you might recall, the Paycheck Protection Program and the economic injury disaster loans of the COVID relief programs. The truth of it is that 25% of small businesses don't reopen after a major disaster. So we can also help you prepare for those disasters. If you go to our website at sba.gov/prepare, you can see ways that you can help prepare for, that wind that destroys your roof, or the flood from the Platte River breaching its bank, or the drought that forced tourism away from your gift shop. You can find out ways to help you prepare for those instances so you can come back if they should ever happen. We also have a specialized Office of Disaster Recovery and Resilience that can help you if you're affected by a disaster declaration, such as the recent fires in northern Wyoming. Or, they offer low interest rates for recovery, not only for your business, but this is the one area that we can assist homeowners also. So definitely look into that to be able to protect yourself in the case of those situations.
Thanks, Tammi. I had a question for you. So I know most of the products outside of the microloan are really that loan guarantee where you work with a lender. For the disaster assistance outside, the COVID is, those dollars are not there anymore. Is that a direct loan from the SBA, the disaster assistance loans?
So yes, that is a difference between the commercial loans and the disaster assistance, is they are direct loans through our Office of Disaster Recovery and Resilience. So that is, you would work directly with sba.gov/disaster, and they can kind of help walk you through that. They do kind of do their own, I want to say quote unquote thing, in that they, they're able to do those low rates, that they have different standards than our commercial loans do. So we typically will refer you to those offices to be able to talk specific details rather than try to direct you ourselves on that.
All right, thank you. I just thought that's an important thing to understand.
Absolutely, thank you for bringing that up.
So next, that's really, we talked ideally about what you need to do to get ready to go to a lender with those 5 C's of credit. What are they going to look at? So what do you actually need to bring to that first meeting? So we kind of went over this a little bit before, but this is a list of the main documents that banks are really going to want to see. 3 years, sometimes 2 years of business financial statements and analysis. If you've got that accountant prepared, or if you're using QuickBooks or another accounting software, you will be able to print out an income or profit and loss statement and a balance sheet for your existing business. If you're a startup, your business aren't going to have that. You'll do that cash flow projection that we'll talk about in more detail next. They're going to want 3 years of business tax documents. They may require 3 years of your personal tax documents as well. What are you going to use the funding for? This should be outlined and detailed through your cash flow projection and your business plan. Personal financial statements and tax returns, that cash flow statement or projection, depending on if you're existing or starting up. And then the lender's going to have their own application that they'll need you to fill out And each lender is just a little bit different on what they're going to have you bring in, what they're going to have you fill out for them. And so again, just going in and sitting down with that lender is really important. It's important for you to have a project purpose for the loan and establish what your budget is going to be, and being able to demonstrate that you're going to be able to pay the loan back and pay the loan back on time. Another piece of advice that I give folks that come in to see me, and usually startup businesses, is then when you're looking for a lender, find somebody that you can sit down and really talk with, that that you kind of speak the same language, right? You understand one another. It's not somebody that's going to talk over your heads, or somebody that's not going to provide you the time and attention that you feel like you should get. So find somebody that, again, you can speak with, that understands you, can have a dialogue with, right? Ask those questions, enable them to ask you questions and answer them. Your profit and loss statement, again, going back to those 5 C's, will show that lender if your business has the capacity to grow or start and service or pay back the loan. That's another term that bankers use. Can you service the loan? What that really means is that, can you pay back the loan in the manner? So a projected profit and loss statement or income statement shows how the business plans to use its assets to make sales, generate revenue, pay expenses. A profit and loss statement can be generated or projected really at any time period, and is usually done on a monthly basis. You can pull it for the quarter, you can pull it for the whole year. A projected profit and loss or projected cash flow is going to go probably monthly to figure out, okay, what are my startup costs? What extra funding do I need in order to make it through those first few months before I get that first payment from my customer? Need to be able to understand and not run out of cash, right? And not be able to pay that loan back. It's important to really understand, and especially with a startup business, is that timeline of when you will need to pay for things versus when you will actually get income for things. If you are manufacturing something, there's a lot of startup costs with those supplies or even retail for that inventory that you need to have on site in order or to create and manufacture to get those to your customer. Understanding how quickly your customers will pay. So if you're a retail business, right, it's kind of once they come into your business or you sell online, you get that income. But if you're a service business or you're reselling items to other businesses, it may be a 30, 60, or even 90-day payback from that customer. It's important that that you understand how your customers will pay. Existing businesses will need to show that they've been profitable and growing. Business startup, again, can utilize the Wyoming SBDC services to assist in completing that realistic cash flow projection.
So PJ, just to draw attention to what they're looking at on the screen on the profit and loss statement. So just want to point out what's included on this. It's a income statement. The top is basically it shows your gross profit, your sales minus your cost of goods sold. And then the following is all the operating expenses. And basically all the expenses that you need to operate are totaled as the operation expenses. And then your gross profit is your total operating expenses, or your gross profit minus your total operating expenses. And that's going to be your net profit or loss before taxes. And so this is basically what your income statement is going to look like, that will show your lender your capacity to be able to manage the loan that you're requesting. Sorry, PJ, I didn't mean to cut you off.
No, don't apologize. Thank you for reviewing that in more detail. Thank you. So another document as an existing business that you should be able to pull, or your accountant should be able to pull, is a balance sheet. And a balance sheet is a snapshot in time for your existing business. It's used by lenders to assess your capacity and collateral. It tells them about the financial strength of your business and how much of the investment in the business has been done by the owners compared to its creditors, compared to other loans that you might have out. You want your business owner's equity to be positive and increasing. This document also shows if there are assets the business owns or is projected to own that could be used as collateral. This document really shows you your business's current assets. So how much money is in the bank, accounts receivable. These are things that you've invoiced out and expect payment for. How much do you have tied up in inventory? Have you prepaid any expenses? Sometimes your taxes, you prepay those. Any other current assets? Fixed assets are the things that you own. What is the value of the machinery and equipment? Do you own any land or buildings? What is the value of those? Other fixed assets you might have, and what is that total? And then those go against your liabilities. So these are the things, the assets are the things that your business owns versus the things that your business owes. So you've got accounts payable, just like accounts receivable. These would be vendors that have invoiced you, but you haven't paid yet. What's the interest you have payable, or taxes that you still have payable? What is some short-term liabilities? And these are loans that you might have that are due within 12 months. And those are your total current liabilities. And then you've got your long-term liabilities. What loans do you have out with a lender? And those are ones that are not completely due within 12 months. You've got a longer term to pay on them. Sometimes the loan will have a short-term portion. That's why this is in there. And then we look at the owner's equity, the capital that they've invested in the company. And so it's called a balance sheet because at the end, the total assets and your total liability will match.
And just to, it's the owner's equity is going to be what your assets minus your liabilities equals. So if the business owes more than what it's worth, it's said to have a negative owner's equity. And so that would be a huge, big red flag for lenders. So you want to make sure that you're really keeping track of that owner's equity. And just a note here before you go on, PJ, your lender might also request to see a personal financial statement from you, which is similar to this document, but for your own personal your finances. So it'll look at your assets and your liabilities to discover your personal net worth. So say you purchased, you have a 2024 RAV4, you would list that vehicle in your assets. And if you still owe $39,000 on that vehicle, then that note due would be listed under your liabilities. Then your assets minus your liabilities would give you your own personal net worth. So that's just another thing that you might want to consider when you're pulling your documents together, is they might actually ask you for your personal balance sheet as well.
Awesome. Thank you, Tammy. Appreciate that. So what if I have a startup business or I'm trying to expand and I really need to prove that my this investment that I'm asking for from the bank or an investor is going to work out? Or how do I even assess that internally before I go to the bank? Well, your SBDC advisor can certainly help you with this startup and expansion cost calculator. So our cash flow projection worksheet. For a startup business, like I said, or if you're projecting increased cash flow for your expansion, you'll need to calculate that and show that to your lender. And again, this is something that you'd want to do as a business anyway, as you plan for the future, right? So this tool can help estimate those costs as well as operating costs of anytime you increase business, you're going to have some additional overhead costs that are incurred just by doing more business. What I'd like to do with this is to really walk you through the key fields in this spreadsheet to calculate your pre-startup and your ongoing monthly costs as well as your expansion costs. So this owner's equity, part of it really reflects the value of your personal resources you've invested into the business. It typically includes assets like equipment, kind of like that balance sheet. And it typically doesn't include cash, but it includes this equipment and materials and the expenses. It's best to practice to include 3 to 6 months of operating expenses in your startup costs, especially if you're a startup business. Expansion, you might have some of that income coming in through accounts receivable, but definitely for a startup business, you'll need that. New businesses typically don't make as much money for the first few months, and almost always not as much as is expected. So having money set aside will be a great buffer. To calculate your cash position, you'll have to subtract your total estimated expenses from your total estimated cash available. In the next section here, we talk about our sales revenues, this top part of your calculator. And this is the income that's going to come in. And you can see month 1, month 2, month 3. This is where that big consideration is. How are your payments going to come in from your customers? Are you a cash business, or are you going to need to invoice out? And what is that term that you have? Sorry. And at the bottom here is really all of those ongoing expenses. So your monthly operating expenses is really important to track. What are the payroll and payroll expenses? So you owe a certain amount to an employee for payroll, but are you considering that above and beyond that, you're going to pay about 14% of that payroll amount to the federal government in payroll expenses, as well as the state government for workers' comp and unemployment insurance? What are the estimated expenses that you've got on utilities? Are you going to budget for repairs and maintenance on vehicles, on the equipment? If you've got a building, are you budgeting for snow removal, for weed and pest control in the spring and summertime? Any software subscription? So it's really important, and we're going to go through this in our next little section, being able to consider absolutely everything that your business might need to pay for in overhead. And this is where a lot of new businesses and business expansion don't really, as they miss something on this expense side of the worksheet. And then they get themselves into a cash flow pickle where they don't have enough to make payroll or pay back that loan. And so this planning part of it is extraordinarily important. And I think one of the most important things about it is that it's realistic and that it reflects the income that you might get and the expense that you might expend. Let's take a look at a scenario where your friend Alicia wants to expand her beauty salon.
Your friend Alicia wants to expand her beauty salon. Her extra costs are listed on the right. What advice should you give her? So taking a look at her costs here in this chart, what kind of advice could you give her based on her wages and expenses? So go ahead and take a look at the costs and what do you think that she should do? So these are some of Alicia's estimated expansion costs. You can use that to help determine what your choice might be, whether you want to seek out a partner or a co-owner to check your startup costs again, or to apply for a bank loan. Okay, if you selected A, seek out a partner or a co-owner, Alicia has been able to refinance her personal home for her original startup estimate, and later she needs to apply for a loan, but she is able to get it up and going at that time. What if you selected outcome B? If you want her to check her startup costs again, here she realizes that her estimates are incomplete. She needs to have $23,340 more than she initially anticipated. And what if she went to apply for a bank loan, option C? It looks like that loan would have been denied by the lender. So she'll definitely need to do some work in order to get her loan application approved.